We want to talk today about something we call maximum financial potential. During our working lifetimes, most people would be very surprised at how much money they earn over that period of time. And we're going to talk about how much we earn and the impact of taxes and debt and other wealth transfers on our lifetime earnings. So we're going to look at a period of 40 years, typical working lifetime, and we're going to assume that it's a household income, husband and wife, young, starting out, of $50,000 a year. What that means is that over their working lifetime, they would make about $2 million between the two of them. But it's not likely that you would end up only earning $50,000 per year for your entire working lifetime. You're going to get some increases, and so we're going to add a 2% increase there. 2% raise every single year. That means that at the end of your working lifetime, you would have earned about $3 million, just a little over $3 million. Okay? Well, in order to illustrate this idea of maximum financial potential, what we're going to do is we're going to make a couple of assumptions. And one of those assumptions, to begin with, is a little bit of a fairy tale, meaning we're going to assume that you have no expenses whatsoever, that everything is provided for you, and you're able to invest your entire paychecks in a savings account. And we're going to start out by investing it at, say, 4%. That means that over your working lifetime, with your earnings, everything that you earn in your paycheck growing at 4%, you would end up with $6,741,751 in your savings account. Now, we said this was a fairy tale, but we wanted to give you an idea of what your maximum potential would be. But we don't live in a world where we don't have any expenses. And so we're going to take a look at how expenses begin to impact our ability to create and develop wealth. So we're going to look at taxes first, because that's the first thing that comes out of our paychecks. And in this particular example, we're going to use 35%. Now, we know that your tax bracket might not be quite that high. It could be higher, it might be lower, but we're talking about all the taxes in our lives. We're talking about excise taxes on gasoline, sales tax, we're talking about property tax, we're talking about Social Security tax, all the taxes. And for most of us, it really does total up to about 35%. And what we want you to see here is, in this example, that 35%, we're going to pay out about a little over $1 million in actual taxes. But if we look over here at what happened to our savings account, it went from $6,741,000 down to $4,382,138. Well, if we only spent $1 million on actual taxes, then why did we lose $2.4 million in our savings account? Well, the answer lies in something called lost opportunity cost. What that means is that we didn't have the $1 million to grow at 4%, and therefore over our working lifetime, it didn't compound for us, and we have a lot less money. So there's the actual cost of what we call a wealth transfer, the taxes, and then there's the opportunity cost, what we could have had if we hadn't have had to pay that tax. Now, in addition to that, in this country, the after-tax debt service, that includes your mortgage payments, your car loans, your credit cards, maybe your student loans, all the things that we borrow money for, the after-tax percentage that the average American spends on those expenses is 34%. And you can see that, again, the actual out-of-pocket expense is a little over $1 million. The actual loss is almost $2.3 million. So now we're over here in our savings account where we are down to a little over $2 million. Still a nice retirement at this point, but we haven't spent any money on lifestyle. We haven't bought groceries, we haven't bought gas, we haven't paid for health insurance, we haven't bought school clothing, all the things that we spend money on, we haven't done that yet. And typically, in our lifestyles today, that runs about 29% of our total income. So I'm going to throw that in there, and you see again the number is $875,000 in actual costs. The lost opportunity cost is $1.9 million. And here we are over here 40 years down the road, and we have $134,835 saved. So the impact of taxes and debt and lifestyle really puts what we would call a drag. In fact, this entire red section down here is kind of like an anchor on your financial ship. It puts tremendous drag against your ability to fund and create and build wealth. Well, typical financial planning thinking would be to address rate of return. And so we come over here and we say, all right, 4% is not a very good rate of return, and many financial pundits would say, hey, you can do a lot better. You can get, let's say you can get 8%. So let's put 8% in there, and let's see what happens to our savings account. With 8%, we go from $134,000 to $351,000. Much, much, much better. So if 8 is good, why not we look at 12? Because there's a couple of financial pundits out there that suggest that you can get 12%. There we have the solution. If we increase the rate of return, we now have over $1 million in our savings account. And certainly we should be able to retire on that. Well, the challenge, though, is that anytime we start increasing return, we also increase the possibility of risk, the possibility of loss. And the problem with that is that we never know how significant that loss might be. So what if we took a completely different approach? What if we looked at, rather than chasing return, we went back to keeping a steady return, something that was reasonable, and we looked at managing our financial affairs a little bit differently. For example, what if we could manage our taxes so instead of 35%, they were only 30%? In other words, just a slight decrease in the taxes that we pay. Maybe we pay a little less in income tax. We adjust our affairs so that we're paying less taxes in a lot of different areas, and it ends up being 30%. Now let's see what happens. This savings account, if we reduce our tax burden by just 5%, all of a sudden, instead of having $134,000, we have almost $472,000. Just that one item, saving a little bit in taxes. So that might be something we want to address from a planning perspective, is where can we reduce taxes? Now, another area that we have a great deal of control over is our debt service. What if we could manage our financial affairs such that we had a lot less debt? We didn't go into debt to buy things. We paid cash for more things. And let's say we could cut that in half. Now look what happens. We now have $1,618,000 in our retirement account. By simply reducing our tax burden and managing our debt more effectively and more efficiently, we now have more money to save, and as a result, we end up with far more money than we ever did by chasing return and putting risk into the process. So our suggestion is that as we work with you, we will teach you some ways to reduce taxes. We will show you something we call the family banking system or the business banking system, because it can be utilized for both families and for businesses. And it's a way of managing, controlling, and recapturing the wealth transfers that come from the process of debt. And so we look forward to sharing some of these ideas and these concepts with you so that we might put you in a better position. So instead of chasing risk, you are managing your wealth and creating it with a great deal more certainty. This is Scott Christensen again, and we hope that you found this information to be valuable. Please take a second to click on the subscribe button, as it helps us to get our educational content out to more people. And if you want to get notified when new videos are posted, then also click the little bell. For more educational content, such as our books and our free members website, strategicwealthbuilder.com, click on the links in the description area below. And thanks for watching.